Hello there. My name is John Sheffers, and this is the Watchdog Symposium. In the Watchdog Symposium, some of our team members get together to discuss some interesting topics or events. And today I want to introduce everyone to Mark Jeffers, our founder and chairman of the board. Mark, say hi.
Hey, how are you, Johnny?
Good. Brian Law is our president. Brian, do you want to say hi? Brian?
Sorry, I had myself on mute. Welcome, everybody, and happy to be here again.
Awesome. And Joe, why don't you say hi?
Hi, everybody.
All right, so we're just going to kick things off right away today. And what I have here pulled up, and you guys can see this, I assume, right? It's the Kraft Heinz Watchdog report. Now, let me start off by pointing out that on our main page, you can easily go to our blog. And if you go to our blog, you could search for Kraft Heinz, and you can see that I've written two different pieces on Kraft Heinz. I collaborated with Mark and wrote one about in September, and then another one I recently wrote in May. And basically, the story on Kraft Heinz is that this is a company that was formed by the 3G Capital and Warren Buffett partnership. And 3G Capital is a firm that specializes in big acquisitions of big brands and then cutting down costs and turning these low profit margin companies into big profit margin companies by reducing expenses. That's their basic formula. And that seemed to be going really well for them, and they had a number of successes. They're well known for owning InBev, for example. But let me see, Mark, when was it? It was a few years ago.
2015, actually.
2015 was the merger. But if we look down at the Watchdog chart, you can see that right here in early 2019, they had a big drop off from a financial restatement and a big impairment. It was 15.7 billion, something like that. And it was a huge shock to the financial world because this safe company run by two of the most successful private equity firms had this big impairment, and then they've essentially had just an absolute avalanche of bad news ever since, as you can see from the Watchdog report. So that's sort of the basic background about what's going on at Kraft Heinz.
Hey, Johnny.
Yeah.
John, can you make the text on the left bigger so that if I'm watching this, I can see what the different area, what are these things of all these red and yellow flags? What are they made up? What are they made up of? And
you can actually condense that, drag that button at the bottom left and condense it right up to the point you were looking at, John.
Let me see. Bottom left. So if I want to grab this button here.
That's the right, the one on the left there.
Yeah. I want to grab this one. Okay. I see.
Yeah. Yeah, it's a great interactive chart. And take it up to that point when you say that, well, actually, you don't really need to do that, but this is one of the big concerns about this particular circumstance was that the company announced as part of their big write-off in February 2019, part of their big write-off, it was stated that all of this occurred in the last quarter of 2018. And just nobody believes that. That's just not a credible thing to say. So what we then look at is, okay, were there any other impairments that occurred prior to that? And what was the nature of them? And in this circumstance, you go back a little bit, you see actually, yeah, there was some smaller impairments, immaterial almost. And that particular when this is a pattern that we look for whenever we see a large impairment, is that you can see here, like this is the details in the Watchdog report that you pulled up, and you can see that, yeah, they had an impairment in 2016 of 58 million and an impairment in 2018 of 49 million. And then in 2019, you've got an impairment of 15.9 billion.
Right.
And this is kind of one of the things that we look at and we say, okay, sometimes impairments are virtue signaling. And a company's trying to tell you they're so pristine in their impairment assessment of their assets, goodwill, tangible assets, et cetera, that they'll even declare something impaired if it's immaterial. And 49 million would be not even a rounding error on the Kraft Heinz thing. And then all of a sudden you get out of nowhere this 15.9 billion, and you just know that there's a lot of conversation taking place, probably the year before, probably coming up to this. Is there some way to avoid it? There's you learn a lot about a company and its culture. So that's where we have questions about this particular merged company and who the players are. Now, of course,
one of the just about this, one of the things that in the research we've done, and this is just a perfect example of this. This is related to the merger. That impairment there is goodwill. That's part of the merger write-off. John, you wrote in your blog, you had that quote from Warren Buffett saying how he overpaid in the merger, and so but this is just it's another story. In this respect, it's really not unique. It's yet another example of the typically negative consequences of mergers. And apparently all these boards can convince each other that this time is going to be different and this is a good idea. And here we're looking at a merger in 2015, major financial restatement, 4 years later, 5 years later. The long-term consequences of these things are not priced in. It took 4 or 5 years, but there were gradual effects leading up to that. You see the price starting to trend downwards. These things, again and again, from the evidence we've looked at, they don't work out the way I guess the board members expect them to. And so anyway, so we've incorporated that into some of our analysis, and it's just such a clear example. Look, don't forget, the past matters so much, and here it's what is it? I think it was almost a $12 a share drop. I think it's close to 25% at that little going off the cliff there.
Yeah.
Or $14 a share. I mean, that's almost 25% of the company. But we can trace the origins. Certainly the goodwill impairment that comes later is related to that merger. So the long-term consequences of these things, the importance of the past, and especially these large mergers like this. You have the smartest investors in the company, and they all think it's a good idea, despite the overwhelming evidence that these things, on average, do not work out